Welcome to the Tomosi Business Training Series. The basis of these sessions is to support the Tomosi Group staff and management to raise their capabilities and performance. This is also a platform to share our experience with young entrepreneurs making an effort to build their startups in Uganda and across Africa. In this session, we continue to explore the principles of basic accounting. Enjoy!
Hello, welcome back to today's Tomosi Business Training Series. My name is Agnes Akech. Today we are going to look at financial statements. What are the categories of financial statement? We'll look at the balance sheet, income statements or profit and loss, statement of cash flows, statement of changes in equity. These are the categories of financial statement. What are the financial statements, or in particular, what is the balance sheet and its components? This is what we are going to look at and understand. The component of the balance sheet, the transaction behind the balance sheet, and what accounting equation is found in the balance sheet. Most cases, you find that the uppermost part of the balance sheets comprise of the assets, and asset is broken down into two categories: the long-term fixed asset and the current assets. We have the liability side, or the lower part of the balance sheet, which comprise of liabilities and equity. Yet again, the liabilities are also broken down into fixed or long-term liability and current liabilities. Then the last bit of the balance sheet is comprising of equity. Equity is broken down into share capital, retained earnings, and probably any other reserve. This is where the interests of the shareholders are taken care of, to see what they have injected into the company during the period of trading or during a financial year. We'll go further to look into the balance sheet, what a balance sheet is. This simply describes where a company stands at a specific date. Every end of year or every financial year end, people will come up and ask for the position. How is that company doing in terms of performance? They are simply looking at the balance sheet in summary. We'll go ahead to explore into the balance sheet, the topmost part of the balance sheet, which is assets. Earlier on, I said the assets comprise of long-term and short-term or current asset and fixed asset. The assets are made up in general of cash, accounts receivable, vehicles, inventories, equipments, buildings, land, deposits. These are resources owned or controlled by a company. Resources that a company or management uses to generate returns on the investment of the shareholders and other partners. In this breakdown, we have fixed asset included in this. For example, motor vehicles, buildings, land, equipments. These are fixed assets or long-term assets. Accounts receivable, cash, deposit, inventories. These are classified as current assets. What are the liabilities here? The liabilities comprise of accounts payable, promissory notes, wages payable, taxes payable. Accounts payable, we looked at it in our first series of the training last week. We said that these are suppliers of the companies. These are creditors, people who have provided us goods and services on credit. Wages, perhaps by the time the months have ended, you haven't paid your employees. So then it turns into liability that has to be paid at a later date. Taxes payable. The same way, the months will end and you haven't paid the VAT, remitted the VAT to the authority, or you haven't remitted the NSSF, income tax. All these have to be classified as liabilities, because at the end of the day, you'll have to make good of these liabilities as a company. We'll move further to look at the lower part of the balance sheet, which comprises of equity. Equity, as I earlier mentioned, this is where the owners claim on assets. Remember, when the owners inject funds into a business, at the end of the day, they're looking at the return on their investments in terms of dividends paid back to them. So, at the lower part of your balance sheet or financial position of a company, you'll find equity. Equity is made up of majorly two components: retained earnings. Retained earnings here is accumulated profit, net profit or net loss. Every time a company makes a profit or makes losses, it is contained or it is lumped up in this section of the balance sheet. Equity is made up of capital contributed by the shareholders in terms of share capital. Then in the equity, you will also find dividends. All these are components of the balance sheet. Section 3, we are going to look at the income statement, which is still a category or type of financial statement. Income statement, we need to understand what it is, the transaction that affects the income statement, the income illustration. We are going to look at that. We shall look at the element of the income statement. The topmost part of the income statement comprises of revenues and expenditure, rather the revenues. Revenues is broken down further. We have operating income and other income. Operating income here means these are the direct sales that arises out of the activities or the services or goods supplied. Other income, these are like a by the way, income that you've gotten not because you've transacted on the core business that you conduct. For example, you can talk of gains on disposals of assets or foreign exchange for companies who have foreign exchange transactions. These are called other activities. They are not direct income, direct revenues. These are by the way. What is this income statement? Income statements depicts the revenue and expenses for a designated period of time. It summarizes sales or revenue and expenses that determines the profit or loss for the period that have just ended. Most cases is on a monthly basis. It is also called profit and loss to some people. What is this revenue we are talking about? Revenue is an inflow of money or other assets that results from the sales of goods or services or from the use of money or property. It is also called income. What about the expenses? An expense is an outflow. Outflow means money is getting out of the company or out of the business. It can also mean use of other assets or incurring of a liability. These are expenses. You paying money out in return for a service or for some goods that you have purchased or you want to acquire. What is other income or expense? This does not come from a company's main business, such as interest, rent, and gains resulting from the sale of fixed assets. Companies present income in a separate section before income from operations. These two incomes have to be presented differently or separately according to the presentation of financial statement for better understanding. Preparing and using a statement of cash flows. This is the third element of financial statements. What are cash flows? How can cash flow be provided? And what is the illustration, or how do we present it? A cash flow is simply a summary of the cash receipts received within a given period of trading or business and payments for a specific period of time. It is a simple presentation or information for the stakeholders or for the users of financial statement to tell you that in this financial period, this is the money that we generated, or this is the money that the company received, and this is the money that was paid out, such that at the end of the day, at the end of the month, or at the end of the year, one is able to look at what came in as cash flow, as cash, and what went out, and what has remained. This must reconcile to what you have earlier, which I mentioned in the component of balance sheet. We said one of the current asset element is cash, or cash at hand, or cash in the bank. At the end of the day, when you prepare your statement of cash flow, the balance at the closing should be equaling to what is in the balance sheet. If it does not reconcile, then there's a problem somewhere. There's an omission, there's an error, or there's a mistake, in other words. The element of cash flow, we said cash flow is broken down into two. There's cash inflow and cash outflow. This is the element or the component of statement of cash flow. Cash inflow has three categories. Have operating activities, investing activities, financing activities. We have talked about money coming in or revenue coming in. When you mention operating activities, what are we referring here? This mainly is generated from the income statement or profit and loss. We are simply looking at what took place in the income and expenditure statement in terms of revenue coming in terms of expenditure incurred, and what was the balance which is carried into the cash flow. Another component is investing activities. This is generated from the balance sheet or financial position of a company. Investing activities, you'll be interested in looking at the assets of the company. What was disposed of during the year? Was it disposed of at a loss or a profit? If there was any disposal of any assets? Or was there an investment in terms of addition of shareholders injection? Did they inject more money? Did the business or company borrow more money from the bank or other lenders? All these are inflows coming into the company in terms of investment. Or you could have ventured into another line of business or another line of project that brings you more income into the business. All these are investing activities. The last component of the cash flow inflow is the financing activities. This one again, if you remember in the balance sheet component, we said the last bit of the balance sheet, you'll find equity, and also you'll find financing as well. You'll find there long-term loans. There you'll find other borrowings, related parties in long term. All these are financing coming to the business to enhance or promote the growth of the business. These are the three first elements of the cash flow statement of a company. The lower part of the cash flow is what depicts the outflows, money going out of a business. Again, this is reflected in terms of operating activities, investing activities, and financing. What are the primary elements of cash flows? I've already talked about operating activities. That this simply reports the cash effects of the elements of net income. I've already explained this earlier. Investing activities, just the summary to give you, reports the cash effects of the acquisition and disposition of assets other than inventory and cash equivalents. The financing activities reports the cash effects of the sale or repurchase of shares, or the issuance or repayment of debt securities, and the payment of cash dividends. Dear colleagues, that is to close the element of cash flow statements. We'll talk about the debits and credits. Every transaction must be recorded. Every transaction must affect at least two accounts, and debit must equal to credit. I remember last time we talked about it. For every debit, there must be a credit. There's always simple illustration of the debit and the credit, what we call in introduction of accounting when you're just beginning to understand account. The simplest way of understanding is to draw what we call a T account. A T account comprises of a left and right. The left side is called a debit and the right side is called a credit. These are just tools to help one understand the balancing equation of the debit and the credit that we are talking about. It gives you, or it explains to you, what should go to the debit and what should go to the credit. Members, we are going to look at the last bit of the financial statement, which is statement of changes in equity. What is the statement of changes in equity? It is simply a reconciliation between the opening balance and the closing balance of a shareholder's equity. It is a financial statement which summarizes the transactions related to the shareholder's equity over an accounting period. Movement in retained earnings and other reserves and changes in share capital, such as the issue of new shares or payment of dividends, are recorded in this report. Why then should we be interested in statement of changes in equity? Or why would you want to understand? Or why should one know? The difference between the assets and liabilities from one accounting period to the next will give you the movement in equity. This information can be obtained from the balance sheet of the entity. However, this will not provide the details of the changes that have happened in the equity, and for this purpose, this statement of changes in equity is required. Dear colleagues, I want to take you back to what we covered last week. Last week we looked at what accounting is and the users of accounting. Hopefully you still have some memory of what accounting is, but I'll just give you briefly an overview. It's an information system that reports on operational activities. It's also the recording of financial transactions, along with storing, sorting, retrieving, summarizing, and presenting it in various reports. It also tells you whether or not you are making profit or your cash flow is, and when and what the current value of your company's asset and liability is. And it tells you the needs. There's need to be a system or set of rules so that you're able to compare entities or products to each other. We also looked at financial users. For example, we talked about investors, who they are, what they need. We talked about suppliers, customers of the business. These are the people who buy services from us and what they need in order for them to continue doing business with us. We talked about the government, what the government required of us, the public, just to mention but a few. In the next training series, we are going to look at what information can be provided by accounts or accounting.
Enjoyed this session? We would like to hear from you. Please give your feedback using the Google form attached or email us at info@tomosigroup.ug and visit our website on www.tomosigroup.ug or tune into the Tomosi Business Series on Facebook and YouTube to enjoy more of our weekly training podcasts. You can also visit our offices at Tomosi Business Park, Luzira, Port Bell Road, or call 0789 901 356.